The housing market collapse Zillow predicted is finally happening, and it's worse than anyone expected. Zillow just slashed their 2025 home price forecast to a mere 0.6% growth nationwide, down from nearly 3% at the beginning of the year. And they're now forecasting price declines in almost 250 cities across America. And this isn't just some minor correction we're talking about. This is potentially the beginning of the largest housing market shift since the 2008 crash. The data is clear. The signs are everywhere. And if you're a home buyer or investor, you need to understand what's happening right now before making your next move. Let me break down the shocking numbers that most real estate experts aren't telling you about. Zillow didn't just trim their forecast slightly. They've cut it for 2 consecutive months. What started as a nearly 3% growth projection has plummeted to just 0.6%. And that's the national average. When you look at individual markets, the picture gets much darker. What's driving this dramatic shift? Inventory. Housing supply is absolutely skyrocketing across the country, especially in what were once the hottest pandemic boom markets. According to data from Altos Research, we're now seeing 34% of single-family listings taking price cuts. That's the highest price cut rate in over a decade, and in some states, the situation is even more extreme. Take Arizona, for example. A staggering 36% of all listings in Arizona have taken price cuts as of February 2025. That's the highest rate of any state in the country. Florida follows closely behind at 31%. These were the darling markets during the pandemic boom, and now they're leading the way down. But it's not just the usual suspects. We're seeing this price-cutting trend spread to places like Georgia and Nevada, both now at 24% price cut rates, the highest in a decade. The sellers in these areas are getting increasingly desperate. However, there's a problem for buyers. While these price cuts might sound like good news if you're looking to buy, the reality is less exciting. Many sellers are still listing their homes at sky-high bubble-level valuations and then making relatively minor price adjustments. We're talking about sellers dropping their asking price from $600,000 to $580,000 or from $400,000 to $390,000. These token reductions aren't enough to make homes truly affordable in what remains the biggest housing bubble in American history when measured by prices and payments relative to income. The affordability crisis is real and it's severe. We need more than just small price cuts to bring buyers back into this market. And that brings me to what I think is the most concerning indicator: buyer demand. The National Association of Realtors just released their February 2025 home sales figures, and they paint a grim picture. February 2025 was the worst February for home sales in 14 years, with only 4.26 million seasonally adjusted home sales. That's down from 4.31 million last February, making it the worst February since 2011. The only comparable period in recent history is the 2008 to 2011 housing crash. So, what we have now is historically low demand combined with rapidly rising inventory and increasing price cuts. This is creating a standoff between buyers and sellers. Many sellers still believe they can get top dollar for their homes, failing to recognize that the market has fundamentally shifted. For many of them, it will take months of their properties sitting unsold before they finally decide to make meaningful price reductions. But here's the good news for potential buyers and investors who've been waiting on the sidelines. Values are already dropping in several states. Zillow's February 2025 home value figures show actual price declines in multiple regions. California, Arizona, Colorado, Texas, Georgia, Florida, and Vermont all saw values drop in February on a seasonally adjusted basis. California is particularly noteworthy because it had been holding strong for quite some time. But recently, inventory has spiked dramatically, creating downward pressure on prices. Washington, D.C. is experiencing value declines as well, and states like Oregon, Washington, and North Carolina are right on the verge of price drops. Zillow is predicting even more significant price declines in 2025 for many markets. Analyzing inventory levels, days on market, price cut trends, mortgage rates, and recent appreciation patterns, we're projecting declining prices in about 20 different states over the next year. Where are we forecasting the biggest declines? Florida leads the way by a significant margin. Our research shows that Florida has completely reversed from being one of the hottest markets during the pandemic boom to now being firmly in decline. We're seeing clear evidence that we're now in a heavy buyer's market where prices are already dropping and will continue to fall throughout 2025. Texas ranks second in our projections for price declines, and the downward momentum there continues to accelerate month after month. The Mountain West region is also showing significant weaknesses across the board. Colorado, Utah, and Arizona are all showing strong indicators of price declines in 2025 based on current market conditions. Oregon and Washington in the Pacific Northwest are also slowing dramatically, with key metrics pointed to imminent price drops. California and Nevada are currently in a precarious position, technically still stable but definitely trending downward. Nevada in particular has deteriorated rapidly since September, largely due to the explosion in housing inventory we're seeing there. But this shift to a buyer's market isn't happening uniformly across the country. The Northeast and Midwest are still experiencing very tight housing markets. In states like Illinois, New York, Connecticut, and New Jersey, prices are still rising and will likely continue to increase. Illinois, for example, shows some of the strongest market fundamentals in the country right now. Why are we bullish on Illinois real estate in 2025? Simple. There's virtually no inventory. Listings in Illinois have plummeted from 42,000 before the pandemic to only 16,000 today, creating an acute housing shortage. New York faces a similar situation, with listings dropping from 50,000 down to 28,000, with no significant recovery in inventory over the past 3 years. Compare that to Florida, where inventory has exploded through the roof and is now at the highest level in a decade. This divergence is creating a remarkable reversal of the pandemic-era trends. We're going to see outperformance in the Midwest and Northeast, and significant underperformance in the South and Mountain West. And this trend could persist for the next 2 to 3 years. Now, many of you are probably wondering, could we see a major crash similar to 2008, with national price declines of 25% or local drops of 50% like we saw in Florida and Arizona? The technical indicators, rising inventory and price cuts, are certainly pointing in that direction. But to see a massive crash, we would typically need an accompanying recession with substantial job losses. The only other 2 times in U.S. history where we've experienced a national housing crash were in 2008 and during the Great Depression in 1929. In both cases, the unemployment rate skyrocketed above 10%, creating forced selling on a massive scale. To understand how the economy impacts the housing market, let's look at non-farm payroll growth. In Florida, non-farm payrolls are up 1.4% year over year, a significant slowdown from the pre-pandemic rate of around 2%, but still positive. Compare this to the last crash when payrolls in Florida started contracting in late 2007, and by February-March 2009, Florida had lost 7% of its jobs year over year. Nevada, which experienced the biggest housing crash of any state in U.S. history with prices dropping 60%, saw non-farm payroll growth go to minus 10% in June 2009. That level of job losses creates a tsunami of defaults, foreclosures, evictions, and forced sales. Today, Nevada's payroll growth has slowed dramatically to just 0.9% year over year, similar to where it was in late 2007. California is even more concerning, with non-farm payroll growth slowing to essentially flat, only 0.1% year over year in January. That's remarkably similar to what happened in early 2008 before California's job market collapsed, eventually reaching minus 7% in August 2009. Values in California dropped almost 40% in that crash. So for those of you waiting for truly massive price declines of 30 to 40%, understand that while it's feasible in certain markets given how overvalued prices are, we would need to see significant job losses to create the forced selling, foreclosures, and mortgage defaults that drive prices down dramatically. Much hinges on where the economy is heading in 2025. Let's look specifically at Tampa, St. Petersburg, which provides a vivid case study of a market in decline. Values are now dropping month over month in almost every zip code in the Tampa St. Pete area. In some zip codes, prices are falling by 1.3% month over month, which annualizes to over 15% a year. Only a few pockets in central Tampa are still seeing appreciation, But that's unlikely to last given the heavy downward price forecast for most areas. For example, in zip code 33607 in Tampa, we've tracked a complete market reversal over the past 3 years. During the bubble's peak, this area showed extremely strong appreciation potential. A year ago, it had cooled to stable or slightly declining prices. Now, all indicators point to significant price drops ahead. This dramatic shift reveals a massive change in market conditions. The reason? A surge in homes for sale, up to 114 on the market, by far the highest level of supply in a decade. Meanwhile, days on market has increased to 91, and the price cut rate has risen to 42%. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. What does all this mean for you as a buyer or investor? First and foremost, understand that we're witnessing a fundamental shift in the housing market dynamics. The pandemic boom towns are rapidly becoming bust towns, while previously overlooked markets in the Midwest and Northeast are showing surprising resilience. If you're a buyer who's been priced out of the market, patience may finally be rewarded, particularly in states like Florida, Texas, Arizona, and Colorado. The price cuts we're seeing now are just the beginning. Sellers are still in the early stages of acceptance, making token reductions rather than truly adjusting to the new reality. But as properties sit unsold for months, more significant price cuts will follow. For investors, the message is clear. The easy money in real estate has been made. The days of buying property in the Sun Belt and watching it appreciate 20% a year are over. More sophisticated strategies will be required going forward, with careful attention to local market conditions. The broad national trends are increasingly irrelevant as we see this dramatic bifurcation between regions. The rental market is also showing signs of weakness, with rent growth slowing substantially across many markets. This adds another challenge for investors relying on cash flow to offset high purchase prices and mortgage rates. For homeowners in declining markets, particularly those who purchased near the peak, difficult decisions lie ahead. Those who need to sell in the next few years may face the prospect of taking a loss or bringing money to the closing table. The longer you can hold, the better your chances of riding out this correction. The key takeaway from Zillow's dramatic forecast cut is that we're not just seeing a minor adjustment or temporary slowdown. The data points to a significant multi-year correction in many markets that were the stars of the pandemic housing boom. The technical indicators are flashing warning signs similar to those we saw in 2007-2008, though the economic backdrop remains somewhat stronger for now. As a buyer or investor, your best strategy is to be hyper-local in your analysis. National trends matter less than ever. Remember, housing markets don't crash overnight. They deteriorate gradually, then suddenly. We're still in the gradual phase in most areas, but the pace of deterioration is accelerating. Those paying close attention to the data will be positioned to make better decisions, while others are still clinging to outdated narratives about housing shortages and ever-rising prices. The Zillow forecast cut isn't just a minor revision. It's confirmation of what the data has been telling us for months. A significant housing correction is underway, and understanding its regional variations and potential severity is crucial for anyone involved in real estate in 2025. The housing market's future is always uncertain, but one thing is clear. The pandemic-era boom is over, and a new reality is taking shape. Those who adapt quickly to this changing landscape will find opportunities amid the challenges, while those who cling to yesterday's assumptions risk being caught on the wrong side of history's next great housing market shift. Thank you for watching this analysis, and please make sure you subscribe for more market insights. If you found this information valuable, share this with a friend and watch this one as well.